Hi all, in this video, and we will definitely need coffee, we're talking about a simple model of the UK economy and updates for 2026 as to economic expectations. Accountants are often asked to explain what's going on to clients, and we do our best, but all economic models are just that. They're models, they're not firm things which can be put in a spreadsheet and perform. They're subject to external shocks, they're subject to measuring difficulties. So a simple model of the UK economy views it as a circular flow driven predominantly by services, because the UK economy, its place in the world is very much a service economy, and some 80% of the services provided of the goods and services, some 80% is services provided by households and firms. There are four main sectors: households, businesses, government, and the international trade sector. And international trade is less important than it was, but it's still very important. Total output, we know, is about £3 trillion. It's regulated by the Bank of England via interest rates, and it's heavily influenced by regional productivity imbalances. And the economy is centred around London. The core sectors and flows: households supply labour to firms and the government, earning wages to spend on consumption or put into savings. And most of government spending goes on the wage bill. If you think of the three sort of core areas of current expenditure, defence, health, and education, the payrolls for those activities are what feed into households and feed into consumption. So government activity is extremely important. Businesses, firms, produce goods and services. As we've said, 80% is it goes to services, 14% manufacturing, 6% construction, and agriculture just 1%. And it relies, firms rely on consumer spending and business investment, and are very sensitive to changes in those items. Government collects taxes. If we're being technical, government actually makes the money and then collects a bit of it back to spend. And it spends that on its public services, infrastructure and welfare, and attempting to manage inflation, which it's done pretty successfully in the UK, despite major shocks, and public debt. Public debt perhaps less successfully, with an aging population. We spend a fair part of GDP on net debt. The external sector, the rest of the world, that involves UK exports leaving the country and imports coming in, making the UK a small but open economy, sensitive to global trade. The key control levers are monetary policy, controlled by the central bank, adjusting interest rates to control inflation and influence consumer borrowing, dampening that down when the occasion demands. Fiscal policy is managed by HM Treasury, insofar as you can say government expenditure is managed, because there are great difficulties in managing government expenditure of a political nature, which are all too apparent in the UK. The structural imbalance is a major constraint where output per head in London significantly outpaces the rest of the UK due to a concentration of high-value professional services. Integrating the 2026 data shows that the core mechanics of the UK model remain pretty stable. But the flows are currently constrained by external price shocks and a loosening labour market. Sometimes people perceive change differently. It's very apparent that households and consumers are spending more digitally online than face-to-face, and that has an impact in markets, in retail shops on the high street, and so on. And you have to really look at the numbers to see what's going on. If we look at the 2026 component quantities, gross domestic product, so total output, real GDP growth, has slowed. And it's never startling. Our GDP growth for some years has been pretty moderate, but nonetheless positive, with a growth predicted of 1.1%. That's the Office for Budget Responsibility, and the International Monetary Fund, is not going to be very different, forecasting 1% growth. The momentum was hampered mid-year by geopolitical trade headwinds and energy price spikes. So, that's apparent in the news. Households, that's labour and consumption. The household sector, it has a pretty loose labour market. The OBR expects the unemployment rate to peak at 5.3%. So unemployment's not a great factor, and again has been pretty stable and stubborn at those levels. While weekly wage growth has moderated, it had picked up, it's moderated to about running at a rate of about 3.5%, which bodes well for inflation. Businesses, that's prices and output. Headline consumer price inflation is projected to average 2 to 3% over the year. The domestic service economy is resilient, but manufacturing and construction have faced tighter times. And, it's very apparent that despite every effort to get the housing market going, it's not going. And in fact, the housing market in the key market of London has stalled as a result of policy changes. And that has implications for the economy and people working in the construction sector. Government, fiscal policy, HM Treasury's day-to-day borrowing remains under pressure. Public sector net borrowing is projected to fall to 4.3% this fiscal year of total GDP, with central spending driven up by debt interest and net social benefit payments. The monetary levers that the government have, the Bank of England has adjusted its baseline interest rate path, with economists projecting a move towards a neutral rate of 3.25% by the end of 2026, as inflationary spikes ease back down towards the 2% target. So if we look at a circular model of this, a circular framework, I'll put one up as a thumbnail. That gives us a good feel for all those numbers and how the economy is performing at this stage in August 2026. So I hope that's helpful, and a discussion of some of the terms is helpful to follow the numbers. Many thanks, and see you in the next video.